Good afternoon, everybody. Good afternoon as a member, a proud member of the economics department, as a provost of Haverford College. I welcome all of you here today for this very special event. Paul Krugman requires very little introduction. He is as close to a household name as any economist has ever or will ever get. And while I'll leave it to my colleague to introduce Professor Krugman formally today, it is my honor on behalf of the college to welcome you here, Professor Krugman. And we thank you for agreeing to share your insights with us. This talk is made possible this afternoon through the generous support of the William S. Commoner 59 Class of 59 Lectureship in Economics. And I want to take the opportunity to describe how this wonderful event came to be. It came from the generosity of a Haverford alum and fellow economist. It was indeed Professor Commoner's vision to give to the Haverford Economics Department the opportunity to invite to its department any speaker that it chose collectively to build on campus an annual event that excited public discourse and economics discourse. Such an event exists in Professor Commoner's department at UC Santa Barbara, and it has energized and engaged the department there for many years and the university there for many years. That same energy and excitement is what Professor Commoner sought to give back to economics at Haverford, and we are indeed extremely grateful for his generosity. The turnout this afternoon, is testament to the excitement and the energy that's been building on campus around this event. And now, with no further ado, I will turn the dais over to my dear colleague, Ann Preston, who will introduce our speaker tonight.
Thank you, Linda. I have the pleasure of introducing our guest today. Paul Krugman is a highly honored economist, currently professor of economics and international affairs at Princeton University. He earned a BA from Yale, a PhD from MIT, and he has taught at Yale, Stanford, and MIT. Professor Krugman's breakthrough scholarship combined the fields of international trade, industrial organization, and economic geography to analyze trade patterns and location of economic activity. Revolutionizing the field of trade theory, his work more closely models actual trade patterns and helps us understand the forces behind increased urbanization and the effects of globalization. For this body of work, in 1991, the American Economics Association awarded him the John Bates Clark Medal, a prize given every 2 years to the economist under the age of 40 who is judged to have made a significant contribution to economic knowledge. In addition, he was awarded the 2008 Nobel Prize in Economics. Professor Krugman has been honored with a number of honorary degrees, including one from Haverford College in 2004. But even a Nobel laureate in economics is not likely to fill a banquet hall to standing room only at Haverford or anywhere else. It's Paul Krugman's role as a New York Times columnist and writer of popular economics books, essays, and blogs that has probably drawn most of you here. Even among our economics majors, only a minority have read his groundbreaking international trade papers. But hopefully they all have read excerpts from his book, The Return of Depression-Era Economics. It was required reading in intermediate macro. In these works, Paul Krugman tackles the big economic, social, and political issues facing the United States and the international community with intelligence, clarity, and candor. We look to him to shed light on the economics behind the myriad of issues that he takes on, including currency crises, financial crises, rising economic inequality, and the effects of globalization on American jobs. And we look forward to his strong opinions and sharp wit. For most of us here, we have been avid readers of his twice-weekly New York Times column for the last 12 years, or we have been regular followers of his blog. So welcoming Paul Krugman to our community today is like welcoming an old friend. Here is Paul Krugman speaking on the mess we're in.
All right. Wow. Wow, this looks like a revival meeting, which means I should be saying something inspiring and upbeat. But folks, this is economics, so it's not going to be like that. All right. So I'm going to talk probably, I hope, only about half the time that we've got. And so I see that we're set up for questions, because it's always, I find, more interesting to have the interaction. But I do want to set the stage, talk about where we are. It's the old line. We used to say that there was a Chinese curse. May you live in interesting times. It's a myth. There is no such Chinese curse, but there should be anyway. And we live in interesting times. That basically, from an economic point of view, over the last 3 years, we have faced the economic challenge of a lifetime. And who do I mean by we? I think I mean the West, obviously the people in charge, the politicians actually running our countries, the financial officials, but also sort of more broadly the penumbra of people who play some role in shaping economic discourse and shaping the terms on which we argue, and shaping the way in which we respond. What is considered to be reasonable? What's considered to be an acceptable or useful response? And so we, in this broad sense, and I guess, given my perch at the New York Times, I'm part of that we have faced the economic challenge of our lifetimes. And we have failed completely. It's been a deeply, deeply disappointing, distressing failure. It's not the Great Depression, and I'll talk a little bit about why it isn't a full replay of the Great Depression. So it's not Great Depression 2.0. It's more like Great Depression 1.3 or something. But it's bad. It's bad, and it's prolonged. So right now, well, officially we have an unemployment rate of about 9%. But if you think that 91% of the American workforce is okay, that's obviously not true. If we add in all the people who would be looking for jobs but don't think they have any prospect of getting one and so are not counted as unemployed, if we add in all the people who are working part-time involuntarily, we're up to around 1 in 6. If we add all the people who have family members who are afflicted by these things, we're up to probably a quarter or more. If we add in all the people who are working at jobs that don't make use of their skills, who are seeing their prospects blighted, we're talking about a large part of the population. And it's improving, maybe, but slowly. We're now 3 years past, more than 3 years past the point at which it became clear that the economy was plunging. And although it's not plunging anymore, we have come nowhere close to recovering. If you sort of ask, on current trajectory, when might we be at anything that might look like full employment? I'm asked that question all the time, and the answer is, well, I usually give some answer like sometime midway through Sarah Palin's first term in the White House. It's a long ways off. And we're not doing anything about it. That's what's so remarkable about it. If you had said if you had said 4 years ago, imagine, here it'll be in the spring of 2011, and the unemployment rate is almost 9%, and there's been very little progress, and the average duration of unemployment, the average length of time that people who are unemployed have been unemployed was 37 weeks, which is where it is right now. And college graduates, recent graduates of college are finding employment prospects extremely bad. They've seen the share of them who are employed has dropped from somewhere in the mid-80s to around 70%, and people's careers are being blighted, and people my age, men in their late 50s, have lost jobs and see no prospect of ever getting a job again, that in that situation there would be enormous urgency, an enormous demand that we do something. This is not a tolerable position. But in fact, we're not doing anything. In fact, the whole issue of job creation has pretty much fallen off the table. So I want to talk about how we got into that state and a little bit about the things that might help, because the problem, just to say, the problem is not that no tools exist. The problem is the lack of the intellectual clarity and the political will to use the tools we have. Now I'll try to talk about how that happened, and then what those of us who think that this is a great tragedy might do, although as always, when I talk, the uplift part is kind of short and not very forceful, but I'll try at the end anyway. Okay, so let me tell you a story first about the way it was. Because right up until, basically until everything went to hell, there was a lot of self-satisfaction among policymakers and among economists. There was a widespread belief that we had sort of at least we'd licked this kind of problem. There are various illustrations I use of that. In 2002, the Federal Reserve held a conference that was a sort of 90th birthday conference for Milton Friedman. And Milton Friedman had famously argued that the Great Depression happened because the Federal Reserve failed to do its job. And if the Fed had done what it was supposed to, nothing, there would have been a modest recession, but nothing worse. And so at that conference, my former department head at Princeton, who's now been demoted to running the world, Ben Bernanke, gave a lovely tribute to Milton Friedman and his co-author, Anna Schwartz, saying, on behalf of the Fed, I'd like to say, you're right, we did it, we're very sorry, but thanks to you and Anna, it won't happen again. The moral being, of course, we now had the knowledge, and so we would prevent this from happening. And, well, okay, it's not Great Depression 2, but something clearly of the same species that the Great Depression did happen again, and the Fed has failed to prevent it from happening. In 2003, Robert Lucas, Nobel laureate, one of the leading macroeconomic thinkers of modern times, gave his presidential address to the American Economic Association. And the theme of that presidential address was that the problem of the business cycle, the problems of ups and downs, unemployment, was solved for all practical purposes. We had this thing under control. And therefore, that researchers should turn their focus to other things, to long-run growth, because recessions, downturns, that was a solved problem, not interesting anymore. And if there was a general perception, based on what seemed to be a pretty long run of experience, that in fact we did have the thing solved. So the phrase that came into widespread use was the Great Moderation. Between the mid-1980s and 2007, yeah, we had recessions. There had in fact been 2 recessions in the United States during that period. But both of them were fairly mild. Both of them seemed to have been cured with effective policies, and so we had the thing under control. And the formula that had been reached and that everybody thought was successful, or almost everybody thought was successful, was that we would leave the job of keeping the economy stable up to the Federal Reserve or to its counterparts abroad, the European Central Bank, the Bank of England. I'd say the Bank of Japan, but actually the Japanese were already encountering long before the kinds of problems we have now. That we could, you could go and do whatever you were doing, the politicians would do what they were doing, but technocrats at these central banks would keep the economy on an even keel. They would raise interest rates if inflation loomed. They'd cut interest rates if the economy was looking weak, and that would take care of the whole thing. Don't worry about major recessions. Yeah, there will be wobbles, but don't worry about really bad stuff because Uncle Alan or Uncle Ben can always step in to make sure that nothing really bad happens and everything under control. In retrospect, not only was this wrong, but in fact that belief contributed to getting us into the mess we're in. because people did take it for granted that the economy was no longer going to be subject to really severe shocks, and that in itself led to an accumulation of vulnerability. Okay, so what happened? In retrospect, the story now seems pretty clear. Unfortunately, not enough people saw it in prospect, and I didn't. I saw some of it. I used to say there was about an entirely different crisis, but people would ask, didn't you predict this crisis? And I would say, no, I was 90% wrong. The only difference is that a lot of other people were 150% wrong. So I'd say that about this one too. I had no idea that something this bad was actually in the offing, or even that it was really possible. But here it is. But in retrospect, the story is the following. At any given time, an economy, we have a lot of borrowing and lending. Debt is an important part, is a crucial part of how you work a modern economy. You couldn't imagine doing all the things we do without some ability for people to run up debts. And other things equal, making it easier for people to run up larger debts is, adds to efficiency. It means that people who have got good projects to invest in or good reasons to spend can do it, and those who don't can make their resources available to others, and that's a good thing. But always people understand that debts can go bad, that people who've borrowed money may find themselves unable or unwilling to pay it back, that somebody who's purchased a house may find that they can't make the payments, and if the value of the house has fallen, they may not be able to honor the loan, and so on. So at any given time, there are some standards. People put restrictions on how much lending can go on. There are notions about what is a reasonable amount, what's a reasonable size down payment for a house, what's a reasonable level of personal debt for people to hold at most relative to their income, and so on. Well, what happened was that during a long period when nothing really bad happened, and also a long period in which there was a steady reduction in the effective regulation of the banking system. Partly because there was deliberate deregulation, partly because as the banking system evolved into new forms, the regulations didn't keep up with that. You had a steady expansion of the amounts of debt that were considered okay for people to take on. Now, it's always important to remember one person's debt is another person's asset. So this is not society as a whole going into debt. A little bit of international stuff. Some of it was borrowing from China and so on, but mostly it's debt that we owe to ourselves, but the debtors and the creditors are different people, and it got much, much bigger. Debt, by 2007, the total amount of U.S. household debt relative to income was twice as large as it had been in 1980. We'd moved into having a much bigger levels of debt. And then came a moment when people said, wait a second, maybe we've gotten a little too far here. Maybe we've got too much debt out there. So this kind of story, is, some people may know, it's associated very strongly now with a heterodox economist who's garnered renewed respect, Hyman Minsky. This notion that you get extension of credit and then a moment of awakening when people say, oh, wait a second. So we have that moment. Paul McCullough of PIMCO, the bond fund, has called it the Minsky moment. Alternatively, my favorite is it's the Wily Coyote moment. Because, if you're not familiar with the classics, Wile E. Coyote always runs 5 steps off the edge of the cliff, and only when he looks down and realizes there's nothing under him. So you had the Minsky moment. Interestingly, by the way, it really was global. It's, or at least put it this way, it was not a U.S. crisis. We think of it as being subprime lending, but even in the United States, it was much broader than subprime. And it was not only in the United States. There were housing bubbles and debt crises through much of Europe as well. More or less equivalent size, actually. So I think of it as kind of a North Atlantic crisis, a North Atlantic Minsky moment, where within a relatively short period of time, people decided that U.S. households had too much debt, that Ireland had too much debt, that Greece had too much debt, and so on. And, okay, terrible awakening. All of a sudden, everybody's required to, no more lending to these people, lots of demands for quick repayment. Crash in a lot of asset prices because lots of assets had their prices inflated by debt-financed spending, and now all of that went away, so housing prices drop. And now what the effect of that was that debtors were forced abruptly to sharply reduce their spending all across the North Atlantic. Creditors, who were no longer making the lending, well, they were not forced to increase their spending. So it's very asymmetrical. When people decide that we need to have less debt, the creditors are not under any constraints. The debtors are. So we had effectively worldwide, because the North Atlantic is such a large part of the world economy, a worldwide crash of spending. And we were actually talking a little earlier about what are the basic principles that you really need to get across in economics. And one of them is that every sale is also a purchase. If a large part of the world buys less, then that means that the world as a whole is going to be earning less income. It's recession territory. It's slump territory. But wait, this is the sort of thing that we're supposed to know how to deal with, right? We just this is where Uncle Alan, or now by the time this came, Uncle Ben, deals with it by cutting interest rates and reduce interest rates, and that's going to make it more attractive for people who can borrow to borrow. It's going to make them want to spend more, and that should, if we do that enough, that should get the economy. That should cushion the effect. Should avoid a severe slump. Well, that's what we did in 1991. When there was a kind of early rehearsal for the current crisis after largely because a commercial real estate bubble burst. It's what we did in 2001 after the dot-com and the high-tech bubble burst. It's what they tried to do in 2008. But there was a problem, which can be summarized in one word, which is zero. You can cut interest rates, but you can only cut them to zero. And basically, the interest rates over which the Federal Reserve has effective control they've typically been running around 0.1, 0.17, basically zero. The interest rates over which the European Central Bank has control, a little bit higher, but no real room for cutting. Japan has been up against the zero lower bound, as the jargon has it, for a long time. And that wasn't remotely enough. Among other things, the way in which lower interest rates stimulate demand normally is very largely through housing. And there was no way you were going to get a housing boom with lower interest rates when you're just coming off a monstrous housing bubble. I just saw, I didn't check this, but a report saying that at the moment 13% of homes in America are vacant. I don't know if that's right, but it's certainly a large number. You're not going to be able to get a large increase in home spending under current circumstances. And so we ran through that line of the technocratic, if you put it this way, the narrow, technocratic, apolitical process by which we dealt with recessions past was not remotely enough to deal with this crisis. We spent so long thinking that everything was under control that we built up a level of debts, a level of overextension that meant that things were not all right, and we were actually exposed to a very great problem. But that's not the failure that I'm talking about, because, all right, that happened. It's not clear to me, even in retrospect, that there was very much prospect of that not happening. We could have had better financial regulation. We could have had more early warnings. Possibly, we might have managed to avoid. It might not have been quite so bad, but it's always very difficult to argue with prosperity. When people are making money, when prices of houses are rising, the people who say, "Oh no, wait a second, this is not good," always end up looking like spoiled sports. They always end up looking, and they're typically, since these bubbles go on longer than you would expect, the people who warn end up looking foolish for a fairly extended period. They keep on saying this is not sustainable, and it keeps on going on. And so I'm not sure that it could have been stopped. But when it broke, that's where the failure came in. Because what we should have done To a certain extent, when Ben Bernanke was praising Milton Friedman, and when Robert Lucas was saying this thing was solved, they had a point, because unlike our grandfathers, unlike the world confronting the Great Depression, we do have at least a fair bit of understanding of this stuff. Yes, people didn't see it coming. Yes, it came as a shock to realize that the normal tools were not enough. But we understood, or at least I thought we understood, 2 years ago I thought we understood, that the problem was that there was not enough demand, that we were facing a downturn because of this sharp cutback in spending. We understood that government policies can be used to prop up demand. We understood that to some extent, there may be other things that the Federal Reserve can do. Just cutting short-term interest rates is not its only policy tool. It can certainly try to promise that it will keep interest rates low for an extended period, perhaps that it will allow some inflation. It can do more. And especially and particularly, we also know that governments can come in and spend. If the private sector isn't spending, governments can come in and spend. And if there was one lesson that we had learned from the Great Depression, it was we saw what it took to end the Great Depression, which was a very large program of deficit-financed fiscal expansion, otherwise known as World War II. And while that was not a sort of intentional policy, the fact that it did end the Great Depression would surely serve as a lesson that, in fact, we can end this thing. What we need is just a really vigorous response. But it didn't happen. Even in the beginning, so there was a period, there was a very special period in this crisis, a period which I went roughly from September 15th, 2008 until March or April of 2009, from the fall of Lehman up to the point where financial markets began to, God, we're all going to die, period. There was a period of real panic. And that was the period when there was a move to do some really active policy. And in some respects was quite large. So we had a large bailout for the banks, a huge expansion of special credit facilities by the Federal Reserve to make up for the fact that private markets weren't functioning. And we had a stimulus plan from the Obama administration, and actually stimulus plans pretty much around the world. But even in that moment, we did not have, it was never wholehearted, and it was never really done with conviction. Or as I say, the people who more or less understood what the nature of the problem was lacked all conviction, while the people who didn't understand a thing were filled with a passionate intensity. It was, a little bit, that we had on the one hand, well, obviously I know the U.S. situation best, but we had President Obama sort of kind of making a case for stimulus, but trimming everything back because of fears that, well, if we name too big a number, people might get scared. And on the other side, the opponents just attacking fiercely, demanding that we cut back. And we had, of course, then Minority Leader and now House Speaker John Boehner saying, this is all wrong when the American families are having to tighten their belts, so the government should be tightening its belt too. And although many of us say, this is really stupid, that was nonetheless a view held with great passion. The result was that even in the initial response, it was never enough. So back when we looked at, and this is not hindsight, this was obvious at the time. When you looked at the projections of the state of the economy that were available as of the beginning of 2009, they suggested that we were going to have, over the next 3 years, a gap to fill, a hole that needed to be filled one way or another, of between $2 and $3 trillion. It was a big, big shortfall in spending, below what would be needed to have anything like full employment. To fill that gap, well, we actually know now that Christy Romer, who was the head of the Council of Economic Advisors, at least proposed as a possibility a $1.2 trillion stimulus, but that was never even presented to the president. What was presented was something that was more like $800 billion, which in Congress was, they kept to a headline number that looked like that, but some of it was stuff that would have happened anyway, so you ended up with something smaller, large part consisting of tax cuts that were not likely to be spent, fair bit of aid to state and local governments, but all in all, something that was way, way below what even the available analysis said would have been appropriate. And if you look at total government spending in the United States, it's an easy thing to do. You can go to the St. Louis Fed website and let it draw the picture for you. Total government spending over the past 10 years, so that's including state and local as well as federal. And looking at that graph, you would never know that there had been a stimulus. The spending is kind of out in the recession and aftermath. No net stimulus. So we never got enough. We got enough possibly. It's arguable that without that program, we would have had a much deeper slump, that we would not have stabilized, or at least not stabilized where we did. Although my view is that mostly, so why didn't we have a Great Depression all over again? What was different this time? Well, part of the answer is we did learn something. During the Great Depression, a lot of central banks actually raised interest rates because they were trying to hold on to their gold reserves, and we didn't do that. So that's banks were allowed to fail right and left, and we didn't let that happen. People realized that was playing with fire. But I'd say the main reason that we did better was actually not anything we did actively. It was simply, actually our salvation was the fact that government is so big. It was the fact that this time around, although wage income was falling and layoffs and people were losing their jobs, the Social Security checks kept coming and Medicare kept on paying the health bills. And so there was a sort of base of government spending that didn't exist in 1929, which provided a floor below the economy. Also meant that we went into big budget deficits because spending went on while revenue plunged, but that was actually a good thing, at least for the time being, because it helped us avoid the worst. By late 2009, it was pretty obvious that those of us who were really upset that with the stimulus that it was inadequate. It was really obvious that whatever was happening, we were not actually on a rapid path back to full employment, though we were looking depressed. So at that point, we all sat down and said, we got to do more to support this economy and help the unemployed, right? Well, of course, that's not what happened. And what happened from that point onwards was, and what is continuing to happen, I would say, is a steady process of dumbing down, of throwing away the things that we were supposed to know. And I have to say, although the initial really bad discussion came from one party, a lot of the dumbing down has actually been a bipartisan effort in this country. In the 2010 State of the Union address, President Obama declared his answer, his big new policy initiative to the troubled economy, which was we're going to have a freeze on discretionary spending. We need to start holding spending down, which was sort of, we need to do that eventually, but I thought that we had an understanding that was not what we needed to do right away. And then in the months that followed, he found a metaphor that he really liked, and he began using it in many speeches, which is American families are having to tighten their belts, so the government should tighten its belt too, which was, of course, exactly the same, literally exactly the same metaphor, often exactly the same words that John Boehner had used in February of 2009 and had been correctly described as an idiot for using, but it became part of the official trope of the administration. A word about Europe. Times when I get really depressed about the U.S. discussion and about what's happened in this country, I get a little consolation from looking at events in Europe as a demonstration that we're not alone in our haplessness. So the Europeans did it. They got into crisis in a route that in its details was very different from ours. So we had complex financial arrangements, securities nobody understood, deeply mysterious goings-on, the whole business with collateralized debt obligations and subprime lending and all of that. And basically we used state-of-the-art levels of mystification to get ourselves into the crisis. The Europeans achieved essentially the same result through good old-fashioned corrupt banking. And so they had massive housing bubbles. The Irish and Spanish housing bubbles were bigger than the U.S. at a national level. You sort of, although the U.S. one was very uneven. So roughly speaking, you should think of Spain and Ireland as having had housing bubbles that were sort of comparable to coastal Florida and Southern California, or maybe even bigger. A lot of it done through conventional bank lending by conventional banks, but with the banks relying a lot on wholesale finance, basically banks borrowing money from other banks in other parts of Europe. And when the bust came, it was every bit as big as ours. With the slightly different story that because Europe does not have a single government, we have had the problem of banks that were too big to fail, or perceived as being too big to fail, and in Europe they now have had the problem of banks that are too big to save. Ireland came into this with very little debt and a budget surplus, but now it's a country there where the markets are betting it's going to default on its debt because the Irish government ended up taking on the obligations of the banks. And so they've managed to find their way into a crisis. And given all of that, what is the European policy response? Well, initially they actually did stimulus kind of like we did. It was kind of funny with some of them. The Germans denounced the idea of stimulus and then proceeded to enact one. So they actually, if you look at what Germany did instead of what it said, it was actually not so different from us. But now, as the crisis drags on, what you have is what appears to be a consensus among European policymakers that what we need to do is fiscal austerity, and we need to stop countries from running the budget deficits that got them into this crisis. We need to not ever allow countries to run the kinds of budget deficits that has led them into crisis, which runs up against the peculiar observation that the big problem countries, with the exception of Greece is everything that people say it was, but with the exception of Greece, none of them actually were running big budget deficits before the crisis. Spain and Ireland they're in trouble now because of the consequences of private sector borrowing. It had nothing to do with fiscal. And I have this conversation all the time when I talk to Europeans. So, how can you make this a fiscal crisis when the countries that got into crisis were running surpluses? And it's sort of, let me explain, and it's really a fiscal, anyway. So they're as in their own way, with much more erudite language, they end up being as completely clueless as we are. On both sides of the Atlantic, there's now widespread belief in the doctrine that says that actually what we really need to do is slash spending. And the way that slashing spending, why isn't that going to increase unemployment? And the answer is it's going to lead to increased confidence, because people will know that the budget's under control, and that will lead to actually more spending by businesses in particular, and so it will raise demand. So my summary of this is that everything will be made all right by the confidence fairy. And the evidence for this, that's an interesting story, because a year ago, there was widespread people pointed to various examples of how this worked in the past. So you had countries, they tell you about Ireland in 1986, they tell you about Canada in the mid-1990s, all of whom did this, and it worked. And then progressively, as people have actually looked at the evidence, every one of these cases has evaporated. Every one of these cases was either an economy that was already booming or an economy that benefited from a large devaluation of its currency against other countries, which gave them a big boost in exports. And I guess one point to make here is that one normal response to financial crisis is a big devaluation that gives you an export boom. And the problem right now is, since this is a global crisis, unless we can find another planet to export to, that's not a workable solution. Okay, so it turned out all of the cases have evaporated, but it turns out that faith in this solution is kind of freestanding. It was built on scaffolding of alleged examples. All of the alleged examples have been demolished, but it still levitates up there and is influencing our debate. Where does that leave us? Well, the debate in Washington, and in a different way, the debate in Europe, is no longer about how can we create jobs. It's only about how deeply are we going to cut. Basically, how many jobs are we going to destroy? Amazing thing. We have no job creation policy. We only have a competition between serious austerity and extremely harsh austerity, both sides of the Atlantic. No real job creation effort. What I take from that, as I said, we failed the challenge. It turned out that we came into this terrible, terrible global economic crisis with an intellectual framework that provided guidance, but without enough real understanding of that framework, without enough real appreciation of it, and without enough conviction on the part of the people who would have had to stand up for it to make it work. In practice, although the tools were there, although and it's always worth saying, I guess, the United States, Western European nations, they have immense capabilities. A country like ours, with any kind of political consensus, is capable of dealing with awesomely difficult challenges. I mean, you see that, of course, you see it typically in wartime, but our ability to find the resources. If you ask, could the United States possibly handle another $10 trillion in debt? Where would he ever find the resources to be able to pay that? Actually, if you look at the additional taxes that would be required to pay the interest on $10 trillion in debt, there would be no problem in doing that if we had a political consensus to do it. We have the resources to do all of this, but we lack the clarity, we lack the political consensus. It's everyone wants somebody else to bear the burden, and people go for economic doctrines that fit their political preconceptions, never mind the evidence, which is what leaves us so paralyzed. Which means that we were okay, we could manage economic policy as long as it was modest-sized, as long as what we required were fairly small adjustments, and as long as those adjustments could be made by a group of technocrats pretty much insulated from the political process. But it turns out that when something bigger is required, we actually couldn't do it. We could, more or less literally, could not get our act together. We were not able to respond. This is a big challenge, by the way. People like myself who have a basically Keynesian view of the world, who updated, modified, but basically have a vision of how the economy works that's pretty much not clearly in the same close family relationship to the views that John Maynard Keynes expounded 75 years ago. Sorry. We have to face up to the fact that we have a theory that tells you what you should do, but no realistic prospect that doing that will actually happen, given the political system we actually have, which is a very difficult position in which to find yourself. So what do we do now? Well, the first question, I guess, is what happens now? And the answer, I think, is that slowly, the economy heals itself. There is one respect in which I've become more optimistic over the past year or so, which is that I was unsure that there was any natural end to this kind of slump. But the more I've worked on it, the more I've looked into the roots, I think there is, which is that the fundamental problem we have is one of a buildup of debt, and particularly household debt, and that is, it's slowly being paid down. Households are reducing their debt. Actually, household debt is falling even in dollar terms, although a lot of that apparently is not so much people paying off their debts as it is people defaulting on them, but still the amount of household debt is gradually falling, and the economy, the dollar value of GDP is continuing to grow, so the value of debt relative to the economy is declining at a perceptible pace, and there is a process of healing that goes on, inflicting enormous damage in the process. Right? It's to say that, well, probably within 10 years the economy will have healed itself does not mean that it's okay. It means that we've seen millions of lives blighted, and particularly we've seen millions of young people have their whole lifetime careers poisoned by the fact that there were no jobs when they graduated. But the economy will gradually heal itself. I wish I could say that I thought there was a prospect of something happening to break that, but I think what we're seeing is that we can't seem to actually do it. We can't actually seem to get the consensus to do anything different. The only thing that, well, again, that the Great Depression was ended not through deliberate policy actions, but through war. There was a late-night TV movie I saw on my TiVo that I decided not to tape because it looked like it was really terrible. But there was some 50s movie about scientists inventing an alien threat in order to bring world peace. And I sometimes think maybe we should have a conspiracy of economists to invent an alien threat to get a military buildup to deal with a non-existent threat so that we get a recovery. But anyway, but that's not going to happen either. So I'm actually pretty dreary about the prospect. I don't think it goes on forever, but I think it goes on for a long time. Longer term, well, one thing I think we've learned, even the IMF is sort of admitting this now, is that we probably set inflation targets too low. If we come into this thing with 5% inflation instead of roughly 2%, well, okay, there are some inconveniences to having 5% instead of 2% inflation, but it also means that you come into the crisis with interest rates about 3% higher. And those extra 300 basis points of potential room to cut interest rates would have come in really handy right now. So we probably should have higher inflation targets, and that's something perhaps we can eventually get people to accept. That we were actually too good at the price stability thing, and that got us wrong. And financial regulation. Financial regulation is imperfect. Given time, the bankers will always find ways around it. They can afford much more expensive lawyers. But that's not to say it doesn't matter. We went about 50 years without a major banking crisis. And that was not because, it's not really because because my father's generation were just more reasonable and sensible people. It was because we had a lot of financial regulations that came in the wake of the Great Depression, and that limited risk-taking, limited borrowing, and helped. So if we can do something like that, we can at least, nothing is forever. But if we could get half a century or even 25 years of relative stability, I would take it. And above all, I guess, we need to do a better job of teaching and explaining. The shock, I think, and the biggest shock for me, given what I do for a living, really, is not the terrible things that have happened in the real world. It's the lack of understanding that's turned out to be pervasive, even within the economics profession. I think certainly a lot of people, my colleagues, my friends, we spent too much time working on the frontiers of research and not enough time communicating the basics. And so we ended up with, it is astonishing how much of the economic discussion that takes place in America 2011 reads as if it could have been taking place in America 1931. It's as if nothing was learned, and that's because a lot of people didn't learn it. And I don't know if we can change that, but we ought to be trying much harder than we do. Meanwhile, you know, I think in the immediate policy fight, we are not going to have good policies, but they could be bad or they could be very bad. So I guess my current crusade is I'm fighting for bad policies in America as opposed to the very bad policies we might have otherwise. And with that, let me throw it up for questions. Thank you. So, I don't know, are we taping this? Because there is a mic there, but we could just have people stand up and talk otherwise. I think it's crowded enough that we should actually have people just wave a hand. I'll try to recognize you. Yeah, back there.
I'm just curious, with an economic philosophy that fails to recognize the problems that are coming, why then should that economic philosophy be just slightly tweaked or abridged in order to give policy corrections for problems that it cannot foresee?
Yeah, that's a good question. So if people didn't get it, since the economic philosophy we have didn't see the crisis coming, why should we believe it has the answers? So I give two not totally satisfactory answers. One is that some of us did not entirely fail to see it coming. So those, you know, it was not the case that nobody saw this risk. Actually, one of the odd things is at two levels. One is the housing bubble. Well, you know, that I don't think that was a problem of economic philosophy. I think that was the data there was clear as that was the clearest thing I've ever seen in my life. But there was just an unwillingness that was more a lack of moral courage than a failure of economic philosophy. And the other was the possibility of this kind of trap, where even a zero interest rate isn't low enough. That was something that had been pretty widely discussed, at least at a certain level. In fact, when I started teaching at Princeton in 2000, we had this little sort of cluster of people who were all worried based on the Japanese experience about this stuff. And it was me, it was Lars Svensson, who's now at the Riksbank in Sweden, Mike Woodford, who's moved, but is one of our leading macroeconomic theorists, and a fourth guy, what was his name? Ben Bernanke. So we did come into this with at least some sense that this was a problem. The other is, okay, Yogi Berra, predictions are hard, especially about the future. It's often, the world's a very complicated place. You're often going to fail to see something coming, which does not mean that you don't have, your ability to make good predictions is not, predictions of real events is not, it's obviously relevant, but it's not the be-all and end-all. Economics is mostly about conditional predictions. What will happen if this happens, rather than what will happen tomorrow? And so I wouldn't put too much weight. Obviously, the fact that people didn't see this coming, and the fact that quite a few didn't think that anything like this could happen, is a strike against. But by and large, actually, the people who are now calling for the kind of activist policy that I'm calling for are the ones who did say that something like this could happen. So people like me are not in the camp of, well, you assured us that nothing like this was possible. We're more in the camp of, gosh, I thought we were headed for some trouble, but I didn't realize it would come so soon and so fast, so severely. And I think that's not as much of a disqualification as anything else. And the people on the other side should bear in mind, you know, all right, I had a rant about Alan Greenspan the other day on my blog. Some of you may have seen it. And in which Alan Greenspan delivered another paper, which is in classic Greenspan style, full of vague wisdom and so on, all ending up with a policy conclusion that does not obviously follow from anything else he said. And I just said, you know, Greenspan doesn't get to do that anymore. He was, maybe once upon a time, he was the great oracle who had the right to just tell us that in his depth of wisdom and intuition, he knew what was going to happen. He doesn't get to do that anymore. But and so people who were really completely wrong, who asserted that there, not only, as he did, not only that there wasn't a housing bubble, but there couldn't be a national housing bubble, I think they have lost their right to weigh in on the debate. Yeah.
You mentioned at the beginning of your lecture
Okay, yes, the Japanese case. Japan had in the 1980s, they had a vast bubble, largely a real estate bubble, though in their case, the real estate bubble and the stock bubble were sort of comparable, and a big debt buildup. The difference was theirs was corporate debt, whereas ours was household debt. So there's a difference in the sector, but it looks in some ways broadly similar. And they found themselves, again, in the same fundamental thing, which is after the bubble burst, even a zero interest rate wasn't low enough. Now, a couple of differences. One is that there's a much stronger case that Japan has a sort of fundamental long-term problem of generating enough demand, enough investment to keep its economy fully employed, because Japanese demography is drastically unfavorable. The Japanese working age population is falling by about 2/3% a year, whereas ours is growing about 1% a year. So that makes it a lot harder to get investment sufficient to make use of their savings. And it's also true that the Japanese have missed opportunities to break out of the cycle of deflation. They had a genuine recovery, a pretty good stretch in the mid-years of the past decade, and they could have used that to break out of deflation and get themselves up to at least 2% inflation, and they just completely failed to do that. They tightened much too soon, so they made a mistake. But I will say that we spent a lot of time. People like me, people like Ben Bernanke, spent a lot of time in the early years of the past decade berating the Japanese for failing to come to grips with their problems. And I think at this point we really owe them an apology. Because faced with similar problems, we have basically done worse. We've had much more unemployment. We've actually been less successful at producing job creation programs from the government. And I've used the column to tweak Bernanke a bit on this, that you can take a paper he wrote in 2001 berating the Bank of Japan for its failure to be more adventurous and unconventional, and point by point it applies to the Federal Reserve right now. But I think what finally comes down is they are superficial stuff can mislead you. You look at Japan, and a lot of the cultural things look different, and particularly we have the language gap, so I never quite know. It's always a question when I'm there when they say something odd, I'm never quite sure whether that they actually said something odd or whether the translator was being polite and trying to anyway. But it's but fundamentally we're quite similar. We're big, advanced countries, stable governments, government officials who are annoying and not ideal, but are not in general idiots, and we've found ourselves in the same kinds of problems. And it is actually awesome how much those of us who were paying a lot of attention to Japan in 1998, 1999 now feel that it's more Yogi Berra, right? Deja vu all over again. Yeah.
Assuming that financial regulation has a limited time of effectivity,
Yeah.
how can we have long-term faith in the economy if the government doesn't take action upon risk until after the fact? And assuming that, whether you support the idea of limitations on the complexity of financial models to ensure that they never exceeded a certain point.
Okay, so of course, regulation is about partly limiting the complexity of the things that financial institutions are going to be allowed to do. And nothing is forever. 30s era bank regulations basically began to unravel in the 1970s. And ever since, we've had sort of growing size mess-ups in the financial system. Savings and loan crisis of the 80s seemed to be okay in the 90s, then disaster more recently. That's all you can expect. So if you're looking for, because stuff will change, new institutions will be devised, technology will change, events will come along. But hey, that's basically financial regulations that were put in, that were in place by 1935, pretty much contained financial excess for about 45 years. That's not bad. Now, I actually, one question obviously is, does Dodd-Frank, does the financial regulation bill that was passed last year have the prospect of doing it, of succeeding that long? And the answer is, I think not. And not so much for a fairly substantive reason, which is that the old bank regulation system was pretty mechanical. If you were a bank, there were certain things you could do and certain things you couldn't do, and there was deposit insurance, and that was the end of the story. The new system did not really crack down on all of the various forms of banking that evolved partly to get around those restrictions. It established a general framework giving the government the ability to rein them in. So it's a system that relies a lot on active judgment, and that worries me, because it's a system that probably would be okay under current management. I'm not a huge fan of Tim Geithner, but I do think he would, if he saw something that looked like clear financial excess, he would use the new powers under Dodd-Frank to crack down. But again, what I always say is this system looks like it could work reasonably well under current management, but it will not work at all once President Palin appoints Ron Paul as Treasury Secretary. So it's a difficult. So we have not built so far anything that's got the kind of endurance that of the system our grandfathers built. But I think we might be able to revisit this, particularly if we get some more serious financial scandals, which I think is a pretty good bet. We might be able to get a chance to do a better round of financial regulation. I tried there, yeah. Okay, healthcare reform. It's been largely irrelevant, I think, to the current story. I mean, if it had been set up to kick in right away, instead of mostly not taking effect till 2014, it might have been mildly stimulative, because it would give people some more security about their incomes, make them maybe more willing to spend. Yes, there are some additional taxes that will somewhat raise business costs, but that's not the problem. The problem we have is demand. So I think it would have been mildly stimulative, though even so, not that much. I mean, one way to think about the whole healthcare system is it largely takes the reform. It largely takes the system we have and adds in a combination of regulations and subsidies to bring the uninsured into that system. It's not all that much money, because although the uninsured suffer terribly, by and large, the uninsured in America are young adults who are cheap, right? We already have socialized medicine for the expensive people, namely the elderly, and so the whole program, the subsidies plus expansion of Medicaid, end up being not much more than 0.5% of GDP. So it's not really that big a thing even when all is said and done. Now, if the healthcare reform had been in place, it would have significantly reduced the misery associated with what was going on. Because one big difference, if you measure in terms of GDP, the European and U.S. recessions have been comparable in depth. Maybe we're even doing a little bit better than the Europeans. But in terms of sheer human misery, ours is far worse, and one major reason is in America, losing your job means losing your health coverage, which no other advanced country would, that's barbaric, and we're unique. But hey, American exceptionalism. Yeah. Okay, short answer is no. I mean, the longer answer, look, we have an important part, it's not the sole part, but an important part of what went wrong here at least in the United States. Now, in Europe, it's not the same story. They, again, managed to arrive at equally bad results from a different direction. But we came into this in an era of bitter partisanship. So that you could say, well, you know, what would have happened? Take the healthcare reform. You say, what would have happened if President Obama had actually listened to Republicans and proposed a healthcare reform that was based on Republican ideas? Well, guess what he did? The Obamacare is essentially the same as Romney Care, which was introduced in Massachusetts. The system that was introduced is essentially a Republican plan. It is the plan that was originally advanced by centrist Republicans in the 1990s and was actually implemented in Massachusetts in 2006, and was something that, you know, a lot of progressives were at least initially indignant, because why are we still preserving this basically gratuitous role for the private insurance companies? And yet, that same plan, the same plan that was a Republican initiative in 2006, became a vile socialist, Kenyan Muslim, whatever thing in 2010, because it was a Democratic president proposing it. So where's the grounds for policy agreement? And then on macroeconomic policy, on fiscal policy, well, there's no middle ground. If one point of view says that we should be spending more and the other says that we are spending less, then the middle ground, I guess, is paralysis, which is not much of a response. So no, I mean, the 1930s, you had overwhelming political dominance for a while by FDR and his party, but not that long, actually. By 1938, he had kind of lost momentum, and then the war gave a new lease of life and allowed a lot of the New Deal programs to be solidified. But you didn't really, what we think of as the sort of bipartisan consensus that used to rule, where we actually had a center, and that was something that happened after 1948. After Harry Truman pulled off his upset, Republicans realized they were not going to repeal the New Deal, and you had a new breed of centrist Republicans, and you also had a bunch of really quite conservative Democrats from the South. We're not going to recreate that. You know, just goodwill is not going to recreate that kind of environment. I think we need, somewhere along the line, we need a climactic election that really settles this debate. And a lot of us thought that 2008 might be that election, but it turned out to be for whatever reason, not decisive enough. It's interesting, you know, we could imagine if Obama's reelected and Democrats retake the House, which could happen in next year, that might be a real wake-up call. If Republicans sweep the field, well, then we'll get it. Although they had that under Bush, and that didn't seem to be a final resolution either. So I don't know what it takes for us to get to a point where we can have some kind of consensus about policy. Okay, I'm going to try way at the back.
How does corporate profits and a rising stock market fit into your story?
Yeah, corporate profits and rising stock market. So, you know, GDP, the economy's output is back to pre-crisis levels. Not much above, but basically back. Wages have been held down by high unemployment. There's been a lot of productivity growth. This is something new in business cycles. It used to be that when you had a recession, productivity fell because companies held on to a lot of workers. So they'd be ready for the upturn. And instead, now they seem to lay off even more workers. So, yeah, I'm not sure I exactly fully understand why profits have done so well. I think there's some things that we haven't quite figured out, why profits have risen so much, but at least mechanically, it's because we've had not too bad economic growth since the bottom of the slump, but essentially no growth in employment and no growth in wages. And the stock market, well, given those corporate profits, price-earnings ratios are not out of line, not not way out of line anyway with normal price earnings ratios. So we're more or less, it kind of makes sense. There's no obvious bubble in the market, but there is this remarkable and kind of distressing fact that corporate profits are doing fine, but the labor force is not. I'm going to try over there. Yeah.
I'm part of this 9% that you talk about.
Yeah.
I'm unemployed. I have a doctorate of musical arts and hit the wall a couple of years now. And I have obviously health insurance because I can't afford it.
Yeah.
And the way I look at the situation with our government, to me it's almost like a crime syndicate. I don't mean to sound glib, but it seems to me, I've read a lot of Noam Chomsky talks about how the corporate influence, the corporate money that goes into Washington dictate policy. Hence, a lot of these problems. I just wanted to
Yeah.
seem to be like campaign finance reform, the money that is needed when someone elected, and there's no accountability for that money, and then corporations have the same rights as people. In
Yeah.
my view, unless that's reversed, it's
Ye-
hopeless.
I think that, well, we still do have the vote, and I know that that's a little too glib because these things matter a lot. But you could have said the same things about America in 1929, and yet we did manage to get a lot of changes. And part of the problem has been that we haven't had enough political and moral courage among the people who should have been leading those changes, but we can continue on that. I would say campaign contributions is a big thing, especially given changes in the rules, which now make it even easier for big money to dominate. I'd also say, and this is something, I don't know how important it is, but in my world, my perception is that it's really severe. The soft corruption that comes from the revolving door is I think a very big thing, and not a lot of people. There may be some people who there are some people who quite literally are making decisions with an eye towards currying favor with the people who are going to hire them for a lot of money later on. I mean, actually, you can hardly go back to the Bush drug benefit. I mean, you literally had the Billy Towson write the bill, then leave Congress and become the chief lobbyist for the pharmaceutical lobby. I mean, it was really, but more that, and we're seeing this now. It's I was distressed to see Peter Orszag go from OMB, I guess, to Citigroup now, and I don't think that Peter is corrupt. I don't think that he was throwing deals their way. I'm sure in his mind he's pure, but it's got to exert an influence on people to not take strong stands, to not because that's that you have to be a member of good standing, in good standing of that group to whom these jobs are available. And we're a lot more of an oligarchy and a lot less of a democracy than we like to imagine we are, and it has gotten worse. And so, sure, those things matter. Part of the reason, I'm obviously I mostly been talking economics, but I have political views. Part of the reason that the stuff in Wisconsin and so on matters a lot, I think, is that there are not a whole lot of institutions in our society that offer any counterweight, and unions. Even though unions are often bad things, they often do, have work rules and so on, and they tend to annoy people like me who are, high, affluent white-collar workers. But gosh, if they are one of the few institutions that stands as a possible source of counterweight to those big money interests. You trying to use the? Go ahead. We can do.
Is it working? Okay.
Yeah.
I think that morality point is actually a very, very good issue. My name's Rich Myers, by the way. I graduated in '95 from Haverford, from the econ department. And what doesn't get noticed, or what I never learned in school, what in the textbooks, was the morality part of macroeconomics and public policy, meaning that when public policymakers advocate on behalf of a specific goal, it affects people. Yeah. So when money is taken from one person and given to another, that's stealing. It's not called that in the public sector, but it's called that in the private sector. When companies are deemed too big to fail because they're politically connected, that's immoral. And when central bankers print money through quantitative easing, that debases the value of the dollar in everyone's pocket across the country. And that's also immoral as well. So there's consequences for trying to completely eliminate business cycles. And I don't think that gets enough attention. It's easy to be a talking head and advocate on behalf of what you believe, but there are side effects to that. And when the government's spending this kind of, you advocate for fiscal stimulus.
Right.
And the argument is that there's a Keynesian multiplier that's greater than 1, meaning that the economists think that the government is going to be more productive with that money than the private sector. And anyone who's sat at the DMV or at the post office knows that's most likely not true. So I guess my question to you is I use a lot of financial modeling in my work, and I'm sure you do as well, and I worry about the unforeseen consequences of what I don't see and what could happen, such as these catastrophic events. Do you think that your policies that you advocate in your column, in papers, on TV, can potentially be harmful as opposed to helpful?
Okay, so the answer to the last one is yes, of course. None of us is omniscient. We all have, it's always possible that you're completely wrong about something and that what you're advocating could be wrong. But of course, if you let that paralyze you from ever taking a position, from ever doing what you can on behalf of what you think is right, then you become useless. And that's as immoral as actually not acting when there's something you think you should be doing is a failure of duty. Whereas refusing to do anything because you might be wrong is a failure of duty. Advocating what you think is right, even though you know it might be wrong, is what you're supposed to do. That's being a responsible adult. I often like to say, it's actually a phrase of mine that I use a lot, that economics is not a morality play. That yes, we care about trying to do the moral thing, but we also have to actually sort of understand how the plumbing works. You have to ask, what will actually happen if you do this? What works? So for one thing, I'd say right away that the whole point, the whole argument about fiscal stimulus is it is not taking money away from the private sector, that it's putting unemployed workers to work who would not otherwise be working, that it's putting savings to use that would not otherwise be mobilized. Now, if you say that's wrong, that's an intellectual question. That's not a moral question. By saying that, I'm saying that the government knows what to do better with the money than the private sector does, you've already prejudged. You've prejudged the analytical question. And that analytical question is not a moral question. That is a question, how does the thing work? Well, and those are the things we have to answer. So if I can just say that this is, you have to, I don't think you can decide what is moral, what is right in this situation in isolation from an understanding of how the thing works. That way lies, because there are many different definitions of morality, is inflation that somewhat erodes the value of people's savings, is that more or less immoral than inaction that leaves millions of people who should be working unemployed? Now, if you deny that that's a real trade-off, well, then we're having an analytical discussion. But I don't see that this is an issue that can be settled in moral terms. I'll add, I've encountered the people who try to do everything in terms of morality. The German officials, you often give impassioned speeches about the immorality of debt. And that's no way to do economic policy. And what I always discover, just to finish, every time that somebody starts telling me that what I'm proposing is immoral, it turns out that embedded in that statement is a view of how the economy works. It's an economic theory, which I believe to be wrong. So it's never actually a pure moral statement. It's always I have a doctrine and you're wrong and I'm right. Well, I also have a doctrine and I believe I'm right and you're wrong. And that's kind of important. Sorry, we have another person here. Yeah.
off what he said in a more specific manner, I have a couple questions. Just like curiosity. First, do you think that QE2 will be effective? Also, I was wondering, yeah, we know that by far the huge majority of federal government spending in response to the crisis went to the banks. And then you also indicated that you think that the federal government should have spent more. Do you think that that extra spending, the $500 billion you indicated, should have gone to the banks? And if not, do you think that the money that did go to the banks perhaps should have not went to the banks and went to tax rebates or something else?
Okay, so let me do those in reverse. So the money, the TARP and the stimulus are different things. When we talk about the stimulus, we're talking about aid to states, tax breaks, and infrastructure spending, and unemployment insurance. That's the stimulus money. The $800 billion we talk about is that stuff. The $700 billion fund that was made available for bank rescues is a different thing, and that was $700 billion essentially of credit lines, most of which will be repaid. You know, there's some dispute now exactly, but the actual losses from all that is going to be much, much less than that. Now, I actually think it was right to provide that credit line, that aid, but I think there should have been more strings attached. I think basically we should have had a larger taxpayer stake in the upside. I would have, even although the banks have survived without any nationalizations, I still think it would have been a good idea to nationalize one major bank, if only to encourage the others. Some of you know the reference there. So that would have been, but the idea that the stimulus was a bailout for the banks is wrong. The stimulus was, by and large, if you sort of try and track it down, the stimulus, if you want to think about it in one characterization, it was actually a bailout for school teachers. Because probably an important chunk of it was aid to the states to maintain education. So that's the right way to do it. And if we had spent, what I would have liked to see from day one was a lot more infrastructure. Because we have lots of infrastructure needs in this country, and the reason we didn't do it, there were multiple, but the reason given was, well, we don't have enough shovel-ready projects. We don't have enough stuff that can be started up on short notice. To which my answer was, if you look at financial crises, their aftermath lasts a long time. So we actually had these arguments in early 2009. If you do a lot of these infrastructure projects, a lot of the spending won't come until the third year. And well, we're in the third year, and we still have 9% unemployment, and so we should have had those. So that's what I would have done, not more money to the banks. QE2. I think we're getting close to end here. So, whatever QE2 is going to do, it's probably mostly done because we're nearing the end. Analytically, I was highly skeptical because, all right, here now back into technical stuff. Think of the government as comprising the Federal Reserve now. So just think, instead of drawing one box with the Federal Reserve and one with the federal government, draw the line to include both of them. And ask what the Fed is doing when it goes out and buys long-term bonds. So what it's really doing is it's buying long-term bonds and selling short-term bonds. It's using bank reserves, which are in effect short-term claims on the U.S. government, or in some cases actually selling off some of its holdings of short-term treasuries to buy long-term bonds. Meanwhile, there's the Treasury sitting out there that has a bunch of debt, some of which is short-term debt, some of it's in long-term debt. In effect, the Federal Reserve is building up that short-term debt and paying down some of the long-term debt. So what's happening is QE2 is basically a reduction in the maturity of federal government debt. And I think it works out to something like a 10 months reduction in the average maturity of federal government debt. Well, that probably has some impact on long-term interest rates, but it's hard to believe that it would have a large impact. Now, the U.S. economy did seem to turn up about the time that it became clear that the Fed was going to do QE2. And then the question is, was that just a coincidence? Was there some signaling? Did people take the fact that the Fed was doing that as a sign that it would be willing to do more in the future? And that's really hard to resolve. But if you actually think about it quantitatively, the amount of fuss that was made over what is viewed properly nothing more than a modest change in the average maturity of U.S. government debt is kind of amazing. It really just was not a big policy properly understood. If anybody understood that, you're beyond me here. But anyway, that was the, I think I can take one more. So way at the back, standing